Hi, this is Jackie Ann Patterson recording a video for Platinum members of Divergence Alerts to show you how to use the divergence scans on the hourly charts. So the first step is to log on to the website at divergencealerts.com. I've already done that. I've covered that in other videos too, so you can check those out. Once you're logged in, come to the hourly menu item and give that a click. So what's happening behind the scenes is that I've got scans running looking for divergences on the 60-minute charts of about 800 symbols. And these symbols come from the weekly options and the S&P 500 components. And between these two, there's about 800 symbols that are getting scanned every hour. And the results of that are being automatically updated to this website under the hourly tab. So the first thing you'll notice is this plot of the hourly divergence count. So this is very similar to the main daily divergence count. This graph shows you the current state of the hourly divergence count, and you can click on it to get a bigger picture, literally to look at. The different types of scans are listed. There's a legend on the side and a table that has the actual count, and they're color coded. So the positive divergences are green, the negative divergences are variations of red. This legend is actually decoded on the help page. And what it is I for intras or intraday charts, M for MACD, H for the histogram or L for the lines, then N for negative divergences, P for positive divergences, and then 6 for 60 minutes. What you see here is that it's building up the bars hour by hour. Now, since the stock market opens at 9:30, the first hourly chart is available at 10:30. And that's when the first scan starts running. It takes about 15 minutes to produce the data, run the scans, and get it uploaded to the website. There's also one additional scan at 4 o'clock to see how everything closed down. Now, the importance of this data is shown by a graph. Bring up here. Here we go. So I did some testing a few years back looking at what happened after we had large numbers of positive divergences or large numbers of negative divergences. So this chart shows you positive divergences. At the time, I was running scans on about 500 tickers. Now the list has grown because the number of weekly options have grown. So the list is about 800 tickers. So it's a little bit bigger. This is getting a little bit watered down. Might be time for a new round of tests coming up here pretty soon, now that I mention it. Okay, so looking at this chart, what it is a count of the divergences, the positive divergences on MACD lines on the hourly charts, and then the subsequent performance of the S&P 500 after 4 trading days. So you can see when there's very few divergences posted, the results are pretty much random. Anything could happen. There's negative and positive results going on. But as you go out further and further, the more positive divergences that get counted up, the more this data skews upwards. So as the divergence count moves up over 100, we're seeing that the subsequent performance of the stock market, at least the S&P 500 index, was moving upwards, and that becomes really true as we get more and more divergences. So this led me to believe that anytime that we saw a count above 100, that was something meaningful going on. To give you a little bit more information, here's a table of the result. What I'm trying to look at is the expectancy of a simple trade that buys in and holds for 2 days and closes on the S&P 500 as measured by the SPY. So that's the trading vehicle, the SPY. And the baseline is just buying on the open, selling 2 days later or 4 days later. And you can see that over time, the market has tended to go up. That's the average. The expectancy is an average of the gains over time. When we have a high number of positive divergences, like when it was over 100, the market seemed to go up even more. And after 4 days, it was more pronounced, going up an average of 2% versus a 1.6 expectancy. Now, when there were high numbers of negative divergences, the market still went up, still tended on average to go up, but it didn't go up as fast. So high numbers of negative divergences are not a sell signal, but high numbers of positive divergences could be taken as a buy signal or as a comfortable feeling about the market at large. So if you want to go from here, let me get back to the website with the data. Here we go. And so that's what this hourly divergence count is about. Now, this is only showing you what happened today, and I'm recording this in the middle of the day, so we've only got so many data points. Okay, if you're looking at this chart and you notice that it is not completely filled in, for example, I am recording this at a little bit after 1 o'clock in the afternoon, and the 12:30 bar is not showing here. You might need to do a reload on the browser. So I'm going to go and hit the little circle arrow thingy to refresh and see if it picks up the latest data. I'm not sure why my internet is so slow today. Lots of people working from home in the pandemic has slowed just about everything down. Okay, here we go, and we've got another bar has filled in. We're seeing the hourly divergence count grow in negative divergences, but it's still not very high. Can you see there? I'll click on it again, bring up the bigger. So you notice how this scale changes to accommodate the changing size of the count of hourly divergences. So we're still not up over 100, so no cause for alarm. And in fact, even if we saw over 100 negative divergences, we just realized that that may slow down the market, not necessarily turn it around. What we're really looking for here is big green bars. When we see the big green bars, that can be a happy time for buying on the positive divergences. Scrolling down, we have more graphs that can show you some of the historical times. So let me click on this and we can see, okay, the last time we had a big surge of positive divergences on the hourly chart was this bar here going up over 100. We come down, kind of have to squint and read sideways. 2020 is the year, 09 the month, 2024 is the day, and we've got about a midday signal. So it was towards late September that we had the last extremely high positive divergence reading. And likewise, you can look at negative divergences. You can look at the MACD histogram positive divergence count. That I haven't done any testing to try and determine the value of that. So all of those graphs give you an overview of what's happening in the market based on the behavior of these key stocks and ETFs in the market, the S&P 500 components, and then the weekly options, which includes a lot of stocks and now a lot of ETFs as well. So if you're interested in finding out which exact stocks and tickers had the divergences, there's two ways to go about this. So one is entirely on the web. You can click on this link for the table of intraday divergences. It's going to take a minute, so I'm actually going to right click and say open link in a new tab and let that get started loading. And while that's loading, I'm going to talk about what else is here. The scripts are automatically bringing up a spreadsheet in CSV format, so a comma-separated list of values of the divergences that have been found on the 60-minute chart. So you can click this link and download a file of the most recent, and that usually happens a whole lot faster. See, it's already done, and we're still loading the page on the website. So this is the fast way to get the results. There's also a list of many of these files get truncated every week because they turn out to be really big files. And I frankly got tired of listing them all on the website after a couple of years of this. So I do have the more recent raw data if you're interested in doing some back testing or trying to assess what has happened over time. Just drop me a line and I can send you this data. So let's take a look at what we have. So on the website, there we go. We have an introduction, and then we have a table of the divergences on the 60-minute chart. These columns are sortable, but I wouldn't recommend it because the file contains all of the divergences that have been found on the hourly charts throughout the entire week. I'm recording this on a Friday, so that means that there's 2,000 rows in this chart. So I think it's better to just leave it sorted by date and time, and then have a look at the ticker. You can see if there's a ticker of interest to you. And you can also look at the type of strategy it was looking for. So say the MACD histogram long, here this has picked up a buy signal for AKAM. The usual things from the other sheets apply, that the price is the price that the divergence occurred. The ATR is doing a calculation of 14 bars back, the average true range, calculating a stop based on 3 ATRs, and then a trade size, assuming a risk amount between the current price and the stop price would risk $100. So that gives a trade size. So you could use that for convenience if you want to multiply out what you plan to risk. The volume search gives some indication of how many times the average volume took place. So the ones here at the top of the list, like the AKAM, this is just happening on average volume. So you may not want to get too excited about it, and especially something like Netflix here, happening at a third of the average volume. Not too exciting. But as we scroll down, we did see some earlier in the day. Here pH is one of the top 1.5 times the average volume, and so on. You get the idea here. This same information is also present in the spreadsheet that we downloaded. Let me open that up. Just click on it and it comes up in Excel. I believe this should be readable in the other spreadsheet tools. It's even readable in Notepad++, although the columns are not so easy to separate out. So you do have to do some formatting with the CSV, and it doesn't have the headers, but it's exactly the thing you were seeing on the website. So one advantage of using this is to be able to copy some tickers. So I'm just scrolling down here, having a look to see just what all is on the list and what the average volume multiple might be. There's a 2 times surge here. Oh, here we go. We've got the copy. So if I come over to my trade station, and I've got a couple others that I pasted in from earlier today looking at it, but I'll paste in the HRB here, bring it up in my usual charting tool. Here's the weekly chart, the daily chart, and then the hourly chart. And let's expand this so we can see in more detail our most recent negative divergence. So you can see it's been sending that negative divergence for a few bars here today, and looks like the stock may be rolling over. Some other interesting ones we have. Let's take a look at Acme. This stock has had several divergences back and forth over the past few days. So it has had positive divergence buy signals, and then it's gotten stopped out. Positive divergence buy signal, stopped out. So here's another positive divergence buy signal. Personally, I would not get too excited. And some, let's see, Boston Scientific earlier today had a bunch of positive divergence buy signals. We could unpack this a little bit, spread out the chart, have a look at what these bars are doing, and give some consideration to taking advantage of this positive divergence forming on the hourly chart. Of course, you might want to look at the daily chart, see if that's kind of corresponding. It's not looking too bad. And I would strongly encourage you to use other indicators and consider the broad market environment, not just relying on the MACD divergences as your only investment strategy. This is here to give you a list of potential candidates and to give you an overview with the divergence count. And that's about it on the intraday divergences. I hope you have found this video useful. Please drop me a line if you have any questions, or leave a comment on the webpage. Thank you very much, and I wish you the best for your success.